Hello everyone, welcome back here to a new video here on Activities. Today we're going to talk about Meta once again. My last video also was about Meta, but since Meta's earnings are coming up, we're going to revalue and look at the company and dive a little bit deeper into the numbers of last quarter and fiscal year 2024. Because I do think there's actually some very interesting data there that you'd want to know if you're an investor in Meta. So yeah, we're just going to dive right back in. If you haven't seen my last video, I would actually recommend my first Meta video, which is from about a year ago, which really goes deeply into the qualitative aspect of the business, that is, the business environment that they're in and the markets. And this is really more of a quantitative presentation. However, we do also talk about some qualitative aspects. Now, the first thing recurring what viewers will notice here is that I have some subtitles here. I think maybe that will be a little bit helpful to some of you guys. Now, they're not completely accurate since they're generated by PowerPoint itself. So I saw the option there to turn on subtitles, and I thought, well, why not try it out? Maybe it's a bit handier in a way to find out what I'm saying at certain points or whatever. Maybe it will be able to retain you guys' attention a little bit better. But we're just going to dive right back into the numbers. So first we're gonna look. I don't know. Okay, we're just gonna do it with the mouse. Sorry, I wanted to press the spacebar, but for some reason sometimes PowerPoint doesn't work that way. Anyhow, this is the balance sheet. You guys, at least recurring viewers who have watched my last video, this should be a little bit more of a. You guys should be quite familiar with this balance sheet. And there are certain aspects here on the balance sheet that are somewhat interesting to look at. For example, if we look at the marketable securities, we see that has increased 10 billion year over year. Then if we look at the PPE, also has increased significantly year over year. And finally, we also have the long-term debt, which has increased significantly year over year. So first, let's dive into the marketable securities. Here we see the cash flow from investing activities over the last 3 years. Now, it is of course more important to look at what happened over those last 3 years, what changes happened. So if we look at that, we see that the net cash flow used in investing activities has almost doubled year over year, largely driven of course also by the PPE investment, which we all know, but also by the enormous purchase of marketable securities, almost from 3 billion to just 25 billion, which is an incredibly large number. And this could perhaps be explained somewhat by the fact that Meta has problems buying all the chips and PPE that they want. So what probably happens here, at least that's my hypothesis, is that Meta, of course, makes a lot of money. They make a lot of cash, and they want to reinvest it into the business. However, they simply can't because the chips are and certain networking assets and whatever and servers are simply not deliverable, I guess you could put it that way, are simply just not made yet. So they do want to buy them, but they can't because they're not on the market. So I guess that is happening. So what you'd see over time is perhaps that some of this purchases of marketable securities goes into the purchase of PPE, or, well, rather what you'd start to see is actually that the sales would go into PPE because they would start selling their marketable securities to put that into PPE. And normally I'm against companies buying a lot of marketable securities because I personally believe that a company, if it has too much cash, should simply return more cash to its shareholders, right? However, in this case, maybe Meta sees some value there in the long term, which is actually something we might figure out later on in this presentation, but probably Meta sees some value there in the long term. So that's probably also the reason why they're doing this instead of returning it to shareholders. Now, it would of course be very interesting to look at what are the marketable securities that they're buying, and we can see that here, and we see that mainly over here in the marketable securities, of course, because the cash equivalents are actually just the cash and money market funds mainly. And so we can kind of see that main parts are in U.S. government securities and corporate debt securities. Okay, and this is all fun and well and whatever, but really what we want to see here is for what is the duration. Because for my hypothesis to be correct, of course, we would need to see perhaps that these securities would be less than 12 months. That is, they would mature in about a year, and after that year they would put it into PPE. Because maybe this year they just can't get the property, plants, and equipment, or mainly for Meta, probably server equipment, and they want to buy that at a later date, right? So for that, we have this little thing here, and as you can see, the value of the less than 12 months debts basically they bought, marketable securities, has increased significantly, right? In December 31, 2023, we see the fair value is about 20 billion at 12 months or greater, and at December 31, 2024, that's about 12 billion or 13 billion. And the less than 12 months securities go to 10 billion, while just a year prior they were only 1 billion. So that somewhat reinforces the idea that they mainly buy these securities so they can keep that cash, get a decent return on that cash, at least adjusted for inflation, right? And eventually sell that, or well, just let it mature. Basically, they're not going to sell it, but basically let it mature. And with that money freed up, then they can buy new equipment that perhaps at that time is actually available there. Certain concerns you could have is that the interest rate sensitivity, right? Because interest rates, they're very volatile at the moment, and it wouldn't be surprising that a bond you bought 1 year ago would actually be worth way less than it is right now. However, in their 10K, it actually announced here that any realized gains or losses resulting from such interest rates changes and from the current unrealized gains or losses would only occur if we sold the investment prior to maturity. Now, what does that tell us? They're not going to sell prior to maturity. At least that's kind of the notion I'm getting from the way that this sentence is formulated, is that they will simply just let it mature and they won't realize any losses, and with that money then they'll eventually buy PPE. Now, what PPE did they buy? Well, we had here a breakdown of their PPE. We see land is a minor part, but servers and network assets is very, very big, obviously increasing about 22 billion year over year. And buildings is another big one, about 10 billion. So they're obviously investing a lot into PPE, right? And we see that also back into their CFO Outlook commentary on fiscal year 2024. If you here look and we see this, we anticipate our full year 2025 capital expenditure will be in the range of 60 to 65 billion. And that they expect capital expenditures growth in 2025 will be driven by increased investment to support both our generative AI efforts and core business. The majority of our capital expenditure will continue to be directed to our core business. So I expect, if we go back this slide, for servers and network assets to actually increase significantly year over year for 2025 as well. This shows us perhaps that they really see some value there down the line. They really see that there's something there that will return significant shareholder value, right? And maybe that's there. I don't know. It's about a lot of money, though. That's kind of the major concern I think a lot of investors have, and also Wall Street, is that it's about a lot of money. It's not just a minor investment somewhere that might return some shareholder value. Well, it's actually a major investment. And if it doesn't work out, they will have wasted a bucket load of money. So it's really, I would say, kind of a risky bet here. That do you believe whether or not the investment in AI and into their reality labs, which is kind of like their VR business, will that return significant shareholder value superior perhaps to certain gains you could have made in other stock or other companies. And that's really the question. Now, if we go to our third point, remember for our balance sheet we had 3 points, right? We had the marketable securities, the PPE, and then the long-term debt. We saw that long-term debt significantly increased. As you can see here, they released some notes in 2022, 2023, and 2024, which is basically just bond obligations, at an effective interest rate, really just at about an average. And I calculated that for you guys. You can see the average cost of debt, so you multiply it all, and then divide that by the total amount of debt, and we get an average interest rate of 5.35% on the debt, which is good. This is just a really good interest rate. There's no problem with that for a corporate business. And actually, to be honest, whenever I look at the balance sheet of Meta, I am actually very fond of this, because Meta is a very low debt company. But I actually think for the financial leverage within the business, it wouldn't be bad to have more debt. Because currently the equity portion on the liability sides or liability plus equity sides of the balance sheet is quite high. They have a lot of equity. And if you know, for a little bit, I guess, more proficient investors, they know that debt tends to be cheaper than equity. So by that logic, if you want to decrease your WACC, you want to get as much debt as possible. Not too much, of course, because then you might run the risk of running bankrupt, but about a 50-50 ratio is perfectly fine. And currently, Meta is nowhere close to a 50-50 ratio. So they would actually need to get a lot more debt. So I wouldn't actually mind even if this long-term debt would even be increased, maybe even doubled. That would actually be very bullish. As long as they, of course, know where to put that money, and they know if they put that money into certain investments that they'll actually return a higher return, right? So if you look at the balance sheet verdict, and kind of like a cornerstone of that same logic of the leverage there is the current ratio, right? And if you look at the current ratio, it's just very high. And since 2022, it's been running up. It used to be way higher. 2020 was about 5, which is absolutely ridiculously high. That's way too high, just so you guys understand. It's just way too high. Now, the normal logic is the higher the current ratio, the better, right? Because the current ratio just simply is the current assets divided by current liabilities. So the higher the current ratio is, the better you can pay off your liabilities. At least your short-term liabilities, that is. Now, you don't want it to be too high, because that is indicative of a certain thing, that is, you don't know where to put your money. That is, a business holds too much liquid assets, right? And at that point, the business might think of returning some value to shareholders, think of dividends, think of share buybacks. Or perhaps, as what Meta is right now doing, is taking the current assets and putting those in long-term, that is non-current assets, right? So they're getting their marketable securities, their cash, they're selling their marketable securities and taking the cash and investing that into PPE. That also improves your current ratio, or at least makes it lower. In a sense, for Meta, that would be improving your current ratio, of course. We would like to see a current ratio of between 1.6 to 2. That's my personal favorite. Some people say, well, 1.2 is also fine. You could say that, I guess. On the other hand, it's also a tech business. It's a little bit of a volatile market that can quickly change and adapt. So I think for such a business that is in such a volatile market, it's not too bad to have a little bit of extra cash. And then a current ratio of 1.6 to about 2 is perfectly acceptable. For a more stable business like Coke, for example, you might want a current ratio of 1.2. But I think overall, the current ratio is just too high. And that's the only thing I got to say about the balance sheet. Current ratio is too high and not enough leverage within the firm. But they're obviously, as you can see with the long-term debt, if you just go back one slide, you can see they're working on it. They're doing their best to get more leverage in the firm, and that's something I really like to see. Now, of course, one concern you could have, and that's a very realistic concern, I guess more of a point you could make, is that they're adding 10 billion in marketable securities, which is U.S. government or corporate debt securities. So let's just say, for the ease of thought, about an interest rate of about 4%, right? Because you have a lot of U.S. government debt in there, about half. And you're buying 10 billion of that in a year, while you're also selling 10 billion of your own bond obligations at about 5%. Make that make sense. How is that in any way realistic, right? How is that profitable? If anything, you hope to play a tie and you hope to basically make as much as you have to pay, but it is increasing your assets and thus it is decreasing your ROIC and your ROA. So why would you do this? I think personally, this might be more of a thing that they're doing to accumulate cash and so they can buy more and more and more PPE next year. And I guess that's kind of the logic. And they hope maybe that they play a tie with regards to marketable securities. So they basically gave out the bond obligations right now, and they're putting that in marketable securities, hoping that to get about 4 or 5% on those marketable securities as well. Because remember, U.S. government debt has also increased in interest rate, effective interest rate that is. So maybe they hope to get about 5% on that. And basically they don't lose any money on it, but they do have a lot of liquid assets that they could eventually put into investing into PPE. And I guess that is kind of the logic, because they don't want to immediately give out bonds at a rate of 30 billion bonds in a year, but they rather spread it over 3-year periods of 10 billion a year, which would be a logical thought. That's very, to be honest, it's a decent strategy. It's not too bad. So I guess that is the thought there. But it's definitely a certain concern you could have. Like, if you don't know where to put your money, why are you giving out debt? Right? Now, if we go and look at the days sales and receivables, the days in payables, we like to see days in payables longer or higher than days sales and receivables, because it does show that you as a company have a certain market power. In 2020 was actually not higher, but since 2021 it has been higher, so that's actually very good. Mind you though that these days sales and receivables and days in payables are very high. They're very high for any company, that is. Even Google has lower, Microsoft has lower, any other company has lower days sales and receivables and days in payables than Meta. But this is still good and there's no problem here whatsoever. If you look at the financial leverage ratio, you can see it's pretty much been 1.5 since about 2022. And you might say, well, okay, that's okay, right? Well, 1.5 is okay, but really we would like to see 2. That means you have 50% equity, 50% debt. That's a good financial leverage ratio. Now, what would be a good company to look at that for? What would be a good example? Well, that would be Microsoft. Microsoft has a financial leverage ratio of about 1.91, or 2 1 year ago, 2.19 before that, 2.45. You see that Microsoft is somewhat leveraging down, even though I think Microsoft could perfectly well have a financial leverage ratio of even 3, which means 66% debt. I think 2.5 is actually better, probably. I think 2.5 is probably the best for Microsoft, simply because of the business model. Remember, Microsoft has a lot of subscription-based customers, so it's very unlikely that those people will leave, and they will be. It's very likely actually that they will be recurring customers, right? So I think for Microsoft can afford a little bit more leverage without taking on much more risk. That's not the same for Meta, but despite all that, I still think 1.5 is very low. And for Microsoft, actually, you could say 1.9 is very low as well. It should be way higher. But I think for Meta, financial leverage ratio of about 2 would be perfectly fine. That would still indicate a healthier balance sheet than they have right now, despite having more debt, right? So if we have to form a verdict on this, we see that the liquidity at least is healthy, so I guess that is a positive point. Activity ratios are good, that is the days sales and receivables and days and payables. We see big investments in PPE and much more to come. Mind you, they want to up that to 60 to 65 billion in capex a year. Now, as long as that returns a positive net present value, I don't mind that, and I think that's good for shareholders. But that's really dependent on how these investments will turn out. And to be honest, I don't see it. I don't know what the return on AI will be. I don't know what the return on VR will be. I have no clue. But they apparently do, otherwise they wouldn't commit so many billions of dollars into these projects. So they obviously see significant shareholder value there. And financial leverage ratio, let's just face it, it's just bad. It's blatantly bad. It should be higher. And it's actually weird that I have to say it. And this is, by the way, a point I continuously hammer on whenever I'm looking at meta. It's in pretty much all of my meta videos, I think. It is the financial leverage ratio, or the current ratio is way too high, or the financial leverage ratio is way too low. They just need to take on more debt. Now, I don't want to keep on beating a dead horse here, right? I want to reiterate. Of course, I see that they are giving out they're giving out bond obligations, and I see that they're trying to improve this point. So that's very good to see. We do see some changes there in capital structure. So actually, you could say they're going in the right direction, and that's a very positive thing. Excuse me for that. Chapter 2, I'm going to talk about the income statement, people. So the income statement, let's just start at the top, right? Let's just start at the top. Let's just remove all that and look at the revenue. Revenue increased year over year 22%. Year prior to that is 16%. They also give us a handy little table for that. And you also see it dissected into business units, which is Family of Apps and Reality Labs. Now, Reality Labs, you can see, is just a very minor business unit. In terms of revenue, it's negligible. And you still see that Family of Apps is, of course, dominant, and that means that advertising revenue is dominant within the business, even more so than at Alphabet, which at Alphabet's already really high. Now, when looking at these numbers, it's very important to remember that it's about the story behind the numbers instead of the numbers themselves. You see a lot of analysts, they continue to look at the numbers like, oh, 28 billion, 28 billion, 28 billion, or 162 billion. You know, these numbers here, 162 billion. So what, 162 billion? I want to know how they got to that 162 billion. Okay, if revenue grows 22%, that's nice, but how did they realize that 22% growth? Where did it come from? It certainly didn't just came out flying from the skies. So let's look at where it came from. And if we look at that, we see here that advertising revenue, which is pretty much just the main part of their business, has increased mainly due to increases in ad impressions and average price per ad. Okay, and they anticipate that future advertising revenue will be driven by a combination of price and ad impressions delivered. So basically the same formula that they had in 2024. What you also see here is that the WhatsApp business increased revenue at 63% year over year, which is good, but once again, 664 million, that's negligible. They might as well donate that to the charity because no one will notice. It's basically just a rounding error in the revenue. But it's nice to see that it's growing quickly, I guess. Now, if you look at the ad impressions chart, we see that ad impressions is growing, but it's growing slower quarter over quarter. And that's not necessarily bad, but it does indicate that growth in terms of ad impressions will perhaps slow down. Now, if you put next to that, of course, the average price per ad, we see that average price per ad was actually negative, so it had a decline in 2023 until it turned slightly positive and then positive in 2024. Okay, and now what's very interesting to look at here is to take the two year-over-year worldwide graphs, right? Kind of look at their growth. So it was responsible in 2023 for 18.75% revenue growth, apparently. And the same in 2024 was responsible for about 21% revenue growth. What's very interesting about these numbers, well, let me just clarify that for you guys, is that they're roughly the same as the total revenue growth. So we do in fact see that actually revenue and the growth of that is very largely explained by this formula, as they said, of course, right? So I put this stuff into Excel because I wanted to look at, hey, maybe we can kind of make an expectations of what ad impression price per ad growth will be in future earnings and somewhat get a formula out of that to form a revenue, right? So if we look at the impressions price per ad, we add those two together, so that is basically adding the 1st of March 2023 and subtracting the 1st of March 2023 of price per ads, right, you get roughly the chart here in the left bottom. Okay, and you see a slight growth there in the trend line, but it is somewhat stable at about 20%. Compare this graph to the actual revenue growth, and you get this chart. And you'll see it has a very high similarity. So what, of course, is the correlation? Because that would be obviously one big thing you would be looking at. And you see that the correlation is about 86%. So it's very high correlation between the two. So yeah, it's very obvious that a lot of the revenue growth is explained by ad impressions and the average price per ad. Now, can we actually put that in a formula to calculate perhaps future revenue growth? Well, if you get a regression analysis on this, we have a couple of statistics that are very interesting to look at. For example, R squared is about above 70, or adjusted R is about 70. That is okay. It's acceptable. In the statistics, for an academic sense, you might say it's a little bit low. However, for a practical case, that is, well, this analysis of meta platforms is actually quite good. Then if you look at the coefficients, we see about 1.11, which is definitely quite well, it doesn't really mean anything, but we'll see that in the formula later. P-value is about 6%, which in an academic sense is high. In academic sense, is the p-value pretty much has to be below 5%, which is kind of like a hard line. Now, in a practical case, I would actually say that it's not too bad. So the formula here would be y is 1.1786x minus 0.04125, which is basically revenue growth is equal to 1.1786 times the ad impressions and the average price per ad minus 0.04125. Wow. So what if you make a calculation on that? Well, this is basically our forecast with this formula for the ad impressions and the average price per ad growth for the next Q1, Q2, Q3, and Q4. That is period 9, 10, 11, 12 respectively. If you put this forecast into revenue growth, we actually see revenue growth 23.17% and so forth. Of course, this is calculated by the formula I just gave you guys in the last slide, which would indicate that these would be the revenues of Q1, Q2, Q3, and Q4, or a total revenue of 200 billion in 2025, which would be pretty much 24% year-over-year revenue growth. That is very high. Actually so high that it's quite, well, it's not unrealistically high, but I do think it is a little bit on the higher end, and the CFO would likely agree with me, because the CFO has actually said in their outlook commentary of Q4 2024 that they expect first quarter 2025 total revenue to be in the range of 39.5 billion and 41.8 billion. Now, of course, it's very interesting to look at, is the CFO usually correct? Well, usually the CFO is correct, and they're actually at the upper echelon of the revenue forecast. So you can see 37 billion was the upper echelon, then we see 36.46 actuals. And you see that basically back in all of the CFO outlooks and the actuals. So it's very likely actually that the revenue in Q1 will be somewhat around 41.5 billion. Yeah, we can talk about Reality Labs all we want. They expect Reality Labs most of the Reality Labs revenue came from hardware products sold. Reality Labs is still kind of like this business unit that they have that they're just losing a lot of money on. And we see that back into investment philosophy, where they say basically we continue to expect our Reality Labs operating losses to increase in 2025. So they're expecting to perhaps invest more, or they're expecting a revenue decline. One of the two. I personally think that they're probably expecting to spend even more on Reality Labs. Increased investments, which is basically one notion that they've reiterated all the time throughout, well, pretty much all of their earnings in the last few quarters. Furthermore, in the sentence right after the one that I marked, They say, we expect this will be a complex, evolving, and long-term initiative, and our ability to support our Reality Labs efforts is dependent on generating sufficient profits from other areas of our business. We are investing now because we believe this is the next chapter of the internet and will unlock monetization opportunities for business developers and creators, including around advertising, hardware, and digital goods. So they do see significant shareholder value here, but that's a very long-term idea. But this once again reiterates that they're really in it for the long term, I guess. If you continue to look at the income statement, of course, it's interesting to look at the geographic breakdown. And mainly what is interesting is to look at the China revenue. This is mainly coming from Chinese retailers advertising on the Meta platform's businesses. That is Facebook and Instagram mainly. And of course, given the tariffs currently, it would be interesting to look at what would this chart look like without China, right? What if you just completely take China out of the equation, right? Just go hard to it and just say China doesn't advertise on Meta's platforms anymore. Well, we basically get this revenue chart, which doesn't look all that bad. We see, excluding China, we actually still have 11% revenue growth in 23 and 21% revenue growth in 24, which is not bad. That's very good, actually. So, honestly, not too concerning there. Obviously, their revenue would take a big hit, right? And their EPS would definitely take an even bigger hit, right? But given the fact that they're also overspending a bit, and they definitely have some cost-cutting measures that they could implement very easily, actually, I think even without the whole of China, that Meta would be pretty much doing okay. Now, would it be doing as good as it is right now? No. But it would be doing all right. Add back the costs, and we get a total cost and expenses at 95 billion in 2024, increasing only slightly from 2023, and 2023 actually increased very, very slightly from 2022. Now it's very interesting here to look at, really, what the story is behind the numbers, once again, and that is, well, these I guess. It's not really the story, it's just a breakdown of them, and especially in percentage of revenues, right? And year-over-year changes as well. We see marketing and sales and G&A has pretty much declined year-over-year in 2023 and 2024, and we see that cost of revenue and R&D have increased in 2024 and 2023. Which is understandable. They're spending more on R&D, which they've said time and time again, and cost of revenue is expected to increase somewhat with increased revenues. So that's not too concerning. And seeing that marketing and sales and G&A actually decreased year-over-year in both years is actually a good sign. So I'm actually pretty positive on these numbers. They actually look pretty good. It looks like they're saving money on the parts that they need less, and they're spending money on parts that they actually need more. And if you look at the story behind the numbers, we see that the cost of revenue, and they say the increase of cost of revenue is primarily due to higher operational expenses related to our data centers and technical infrastructure, mostly from higher depreciation expense. So simply because they invest more into their business, they have a higher depreciation expense, which is depreciated within the cost of revenue segment. So actually, maybe the cost of revenue didn't actually increase. It's just the fact that they're investing more in their business. What happens is that these depreciation expenses are actually made within the Reality Labs division, where they test their AI and test their VR stuff, but they have to be shown, of course, in the cost of revenue of the overall business. So perhaps the advertising business actually got more efficient within the year, right? So it's not that costs really are increasing, it's more that they're making costs because they're investing back into their business. So actually, this is not too bad of a sign. R&D, well, we all know why R&D increases, just because they're doing more and more research and development. And it mostly increased due to higher employee compensation, as well as infrastructure costs for R&D. The higher employee compensation was mainly from 13% growth in employee headcount in engineering and other technical functions. Not too bad. They're spending more money on people that can make new products. Not too bad of a sign there. And M&A and G&A, of course, or M&S, I should say, and G&A actually decrease year over year. Now G&A is actually interesting to look at because it decreased mostly by a favorable impact of 1.5 billion in legal related costs. Okay, so you could say that the G&A was actually not 9.7 billion, but in next year will be very likely back to 11 billion. So we don't actually see that big of a decrease in G&A as is shown here. So if we look at the segment profitability, we see that all total income from operations is 70 billion last year, pretty much 46 billion before and 30 billion before that. Which basically gives us the following statement, but this is without China. Okay, this is without China. And keeping pretty much all the costs, except the cost of revenue, keeping those the same. And we see actually pretty good numbers still. Now there's a case to be made to say, hey, cost of revenue should actually increase as well because it's mainly due to depreciation expense, not due to the Chinese cost of revenue. And you would be very much correct on that. But even despite if we would even increase our cost of revenue on that, operational income would still look very, very good. And definitely no concerns there. Then if we look at taxes, their effective tax rate is about 12%, which is partly due to, of course, increased investment. For people that don't know, investments, you can actually subtract that somewhat and reduce your tax rate that way. And they also have higher share-based compensation, on which they say, if our stock price remains constant to the January 24, 2025 price and absent any changes of our tax landscape, we expect our effective tax rate for full year 2025 to be in the range of 12 to 15%. Now, actually, of course, the stock price plummeted over the same period, which is almost kind of funny. You can judge that very likely their tax rate will be about 12% on the lower part of this statement. If you look at the of course, this would obviously raise some concerns because some people might say, but okay, that's about the income tax, but what about the balance sheet? They wouldn't see we see long-term income taxes over there. What's about that? What's that all about? Well, the unrecognized tax benefits, that is, had an uncertain tax position of 9.9 billion. And they say about it in the last sentence, based upon the status of litigation described below and the current status of tax audits in various jurisdictions, we do not anticipate a material change to such amounts within the next 12 months. So this is something for a prolonged period of time, and I don't actually believe that it is going to be resolved in the next 12 months. And if we make the income statement here and we put the percentage statements right there next to it, it shows for us quite a good picture. I mean, it's not looking too bad. It's not looking too bad. Actually, not looking too bad. What I should say is looking very good. Net income has increased significantly. The profit margins as well increased from 29 to 38%. Looking very good. Just very good numbers here overall. And if we then create somewhat an income statement for Q1, I think a conservative estimate would be a net income of 14 billion. That is 15.47% net income year-over-year growth, and EPS at 5.51 is 17% year-over-year growth. That is adding additional depreciation expenses. That is keeping R&D growing, that M&S and G&A keeping it higher as well. Yeah, so overall I think this is a pretty realistic picture somewhat of Q1. Healthy 15% revenue growth expected with higher EPS growth, and the main headwind for net income is expected to be depreciation. And actually, let's look deeper into that picture, because here we see the useful life of the servers and network assets actually increased from 4 years to 5 years, and they increased that to 5.5 years even. And that way they generated about 2.9 billion. Isn't that wonderful? Just by changing some numbers, you suddenly make $3 billion. Isn't that wonderful? I wish I could do that. We see that PPE has grown about 35 billion, which is about roughly the same as the 37 billion shown in the cash flow statement. And from this, we can actually somewhat calculate an additional depreciation expense in Q1. And for that, we need the 3 months ended cash flow statement and need the purchase of PPE, which is about 14 billion in that quarter. If you put that depreciation cost here with the servers and the buildings, right, and we take the annual of that and make it quarterly, then we can actually add it to our income statement. If you add that to the total cost picture, okay, we actually get a net income growth of about 11.7% and 13% earnings EPS growth. Is it realistic? I don't know. It could be, somewhat. I wouldn't be completely amazed or completely surprised if this would be the picture, but it wouldn't be very good. The verdict final is eventually that the growth in the short term will be lower due to increased investments in long-term projects, and I think that's the overall idea. To make a counterpoint to that, however, is that the profit margins of 38% are more than capable of taking a hit. They have a lot of leeway there, so that is good to see. Now let's continue to the next statement, which is the cash flow statement. And we also already kind of talked about this in the prior segments, but I just wanted to look at some aspects of this cash flow statement because some aspects are really, really beautiful. First, looking at the operating activities, not much here except the share-based compensation, somewhat to look at and keep in mind. So for any of us, I would actually be a little bit more attentive to the share-based comp, and of course also depreciation expense, but we already looked at that in prior segments. If you look at the investment activities, we pretty much already talked about that, right? We pretty much already dissected this in the balance sheet segment. PP is increasing significantly. Also the why as to why marketable securities are increasing. So overall, it's looking okay. If we look at the financing activities, and this is the part we haven't talked about yet, but it looks fantastic, really. We see that repurchase of Class A common stock is 30 billion last year, up from 19 billion before that, and a little bit higher than the 30 billion, but even before that. This is very good. It's just looking very good. That's definitely not bad. Dividends. They also announced the dividends last year, of course, so they paid out 5 billion in dividends. Not looking bad. That's actually very good. They're returning some shareholder value. That's what we like to see. And we also see, of course, the issuance of the long-term debt, which, given their current ratio and their leverage ratio, is definitely a very good sign to see that they're taking on more long-term debt. Another aspect, of course, that's very important is the free cash flow. And if we look at the growth numbers over there, we see 133% free cash flow growth in 2023. And in 2024, we see 21%. My expectations for this is that free cash flow will actually stay flat, if not decline, a little bit in 2025. Simple reason for that is increased CapEx expenditure, or actually I should say capital expenditure, or increased CapEx. While operating activities is very, very dependent on revenue growth and actually more or less net income growth, of course, because that's where they're taking from. And I'm expecting revenue growth to be lower than, of course, the PPE growth, which is expected to be about 80% growth, right? So I'm expecting free cash flow growth to stay at least flat, if not decline a little bit year over year in 2025. And that's one thing to keep somewhat in mind with regards to Meta. Overall, the cash flow statement, I really like the cash flow. Investments in long-term projects, which is good to see, returning more value to shareholders, and we see some capital restructuring, which is also good. Overall, cash flow statement looks very healthy. Then we have some other things we would want to mention, which is, of course, the FTC case. It is the TikTok ban and the VR market size in 2030. Talking about the FTC case, I think it's not a major concern for shareholders if you just dive deep into the case. it's absolutely nonsensical as to what the claims are that the FTC makes. So I'm not too concerned about the FTC case having any significant impact on Meta platforms. TikTok ban could potentially increase DAP for Meta and especially more ad impressions for Meta, which would eventually lead to a higher price in ads, and that eventually that combination would of course lead to higher revenue growth. So the TikTok ban is something to look into and keep in mind for Meta investors. The VR market size is expected to seriously increase in 2030, or at least until 2030, I should say. And Meta owns about 50% of this market currently, or even maybe more. Some sources even say 75%. So that's also something to keep in mind, and that's perhaps also the reason why Meta is investing so much money into this segment. So actually, to those investments, there might be some merit there. That's what I'm trying to say. My major long-term concern is more or less that Gen Z is continuing to use less and less Facebook, and perhaps also a little bit less of Instagram, even though it's more than the general population, but they're using it less than TikTok. And especially, I think, on time spent on the apps, I think more Gen Z spent more time on TikTok than Instagram. If you look at the number of Gen Z users in US on selected social media platforms from 2020 to 2025, we see, however, that the picture doesn't look necessarily that bad. We see Facebook is still even up there, so that's very good to see. Now, why I'm looking at Gen Z is because I mainly want to look at the younger audiences, right? Because those younger audiences are really going to drive revenue growth in the upcoming decades for this company. Because Gen Z and of course you have Gen Alpha after that, they're going to be the new users, new consumers, and they're going to drive revenue growth potentially for Meta. If you see social network where US adults are likely to make purchases directly, we see that Instagram is up there, and it's especially at Gen Z, it's very high. But Instagram is higher than TikTok in pretty much all two age groups. And it is, but the difference is honestly negligible. And we see the Gen Z time spent on social media for 35% is more than 4 hours. Can you guys believe that? More than 4 hours spent on social media a day. Not a week, a day. Insane. That's why, for example, I have honestly limited my social media apps. You can do that on your phone. I've limited to about 1 hour a day. I don't want to spend more than an hour a day on social media. Simply for the reason that I don't think that spending more than 4 hours a day on the social media platforms is healthy. There's no way that is healthy. And you see that back into the Gen Z attention span, which has decreased. It's continued to decrease generation by generation. And also some, of course, reports about excessive use of social media, which is definitely more than 4 hours a day, definitely falls under excessive use of social media, lead to negative health outcomes, such as social anxiety, depression, low self-esteem, reduced sleep quality, and higher perceived stress. And the question here is mainly, A, what will be the regulatory impacts of this on Meta's business, right? And B, do you want to invest in such an ethically dubious business practice? And I guess that's the main question. But I'll leave that up to you guys. If you look at the leadership, and there are definitely some notable things here, is first of all, pretty much all leaders here, or all executives, have been with the company for a prolonged period of time. And if you put that into a statistically thing, we see that the average tenure at Meta platforms is about 20 years. Average tenure at S&P 500 firms is about 7 to 8 years. So the longer tenure, generally, the better. So this is a very good sign. It's an incredible sign. Very, very, very bullish sign. Because the longer that a person is at a firm, the more affinity that they have with that firm. And overall, the more they will care about that firm. And of course, that's very good for the firm overall. If you look at the age at Meta platforms, which is also very notable, it's normally not very well-mannered to talk about a person's age, but in this case I think it's somewhat relevant. We see the average age of S&P 500 executives is about 54 years, and I think for a company that is focused on a young audience, this is a good sign. So that's my main critic there, or critic I should actually say, main feedback, and it's good feedback, right? So what if we look at the valuation? Well, first we calculate the WACC, and we took the CAPM formula to calculate the equity costs, which is about 13.829%. You might say, hey, how does that work? Why did you... Well, because whenever I do the CAPM formula with these numbers, I get to a number of 12%. And that's correct. That's because I doubled the beta. So I basically did the beta times 2 minus 1. That basically increased the unsystemic risk of meta platforms in a quantitative sense. Why did I do that? It's because I think beta is a ridiculous number. It's a ridiculous way. If you look at how beta is calculated, you can see that in no way does it represent unsystemic risk for a company, or even risk for a stock. It makes no sense. It generally doesn't make any sense, because if you look at the formula for the beta, you see it has to do with covariances. And the variance of a stock compared to the underlying comparative part, which is usually the S&P 500, and it makes no sense, because if a stock goes up more than the S&P 500, then the stock has a higher beta. And then people would say, oh, well, this stock has a higher risk because the beta is higher. Why? Why does it have more risk? Simply because the stock did better than the S&P 500? You see how this logic doesn't make any sense? So what I said, okay, well, for the unsystemic risk, I need some quantitative form. I just take the beta and basically take the unsystemic risk part, which is 0.27, and double that, just to be safe. And then you get a CAPM of 13.829%. The average cost, we calculated that, at least the average cost of that, in the balance sheet per segment of this video, and you can see that that is 5.35%. Tax rate in the US is about 21%. Which gives us a WACC percentage of 10.58%, which is a very high WACC actually, and that's mainly because, as you can see, the equity portion is very large. And this is why I'm hammering so much on taking on more financial leverage, because as you can see here, the average cost of debt is way lower than the CAPM, which is the average cost of equity. So that means you need to take on more debt, because that will lower your WACC, and your WACC is the number that you'll discount your future cash flows with. And if you decrease that number, your future cash flows will be better. It's just a simple mathematical rule. So that's why I'm hammering on taking on more debt. Assumed growth rate, we take 19.40%. Because, and how did I get to that number? Well, we basically calculated the RONIC, which is the return on newly invested capital, sometimes also called the ROIC, which is the return on incrementally invested capital. And we pretty much timed that with the retention rate of the operating cash flow. And then we get an assumed growth rate of 19.40%. Okay? Yeah. And actually, it makes total logical sense, because if you think about it, the return on newly invested capital is 78%. Okay, so if we invest one more dollar into the business, if we assume that we get 78 cents back, right? Every year, that is. And how much of the money that we're making a year are we actually investing back into the business or keeping in our business? That is our retention rate. So times the RONIC times the retention rate, we obviously get an assumed growth rate. That makes perfect logical sense. So once we put that into a discounted free cash flow statement, which is pretty much the only discounted cash flow model that we need to value the business, right? Remember, sometimes I see people use 10 different valuation models, which is honestly just time wasted. Because the thing is that you should spend more time on gathering your data than the models that you use. And pretty much the only model that is somewhat realistic, and honestly the superior model, is the discounted cash flow model. And we're not going to use any other model, simply for the reason that it doesn't make any sense to. There's only one model that's really good, and that is the DCF model. Okay. And the rest of the time is all spent on gathering data. So that's reading statements, reading CFO outlooks, reading news articles and other articles by analysts. So yes, your time is better spent on spending on gathering your data, because remember, shit in is shit out, and we want to have good data and good data out. And we get to, if you have a growth rate of free cash flow, this is a very conservative statement, by the way. We first expect our growth rate of free cash flow to be 0%, as I told you guys in the first point of this cash flow analysis, right? We looked at the free cash flow, and I told you guys it's probably going to be about 0%, at least that's what I expect. And expect the second year to perhaps be a little bit higher, since a lot of these PPE investments will have been made by that time. And then after year 3, we're going to continue with the 19.4% growth rate. We have a WACC of 10.58%. We put that into our free cash DCF calculator, and we get a fair value price per share of $622. Okay, what is the net present value of that? $102, which basically indicates for us that this stock would be a buy. Now remember that this is just an implication, it's just an assumption, and this is in no way, of course, guaranteed. I would like to thank you guys for watching, and if it was helpful, please leave a like. Thank you very much.